Good morning, everybody. It is October 1st, the first day of the fourth quarter. And so we have a lot of new things coming here. The first new thing is a new article called Macro Dashes. And the first topic I covered is inflation transitory? Because I think a lot of people are jonesing about what's really going on in inflation. And there's this drumbeat, right? The chest pounding, foot stomping, the dollar collapsed, the dollar collapsed, the dollar collapsed, hyperinflation, Weimar Republic. As I've said before, when you hear that stuff, resort to your farmer's words and call bullshit. Because the reality is that the dollar hasn't really moved in 50 freaking years. 50 years, the dollar hasn't moved. So when you take a look at the fact that we have a range-bound currency, despite everything that comes and goes, despite some of the stupid things that at least one Fed chairman has done, I use green to denote that stupid Fed chairman, you have to start thinking, maybe there's something else at work with the dollar and inflation. Maybe it has to do with slow growth forever, with aging demographics driven deflationary pressure. And maybe the dollar stays firm-ish because America has no economic peer. I think actually all those things are it. So way back here when the dollar spiked, what was that? That was Paul Volcker saying no to oil inflation. Back here in the early to mid 90s, everybody still had inflation on their mind, even though there wasn't any. Greenspan raised interest rates anyway. Technology was able to overcome the higher interest rates, and we should keep that in mind. In this period in the 90s, technology was able to drive productivity and new profits with asset-light models that overcame higher interest rates. So the dollar actually rose, despite there being no inflation. So could we see here the dollar rise, but technology still make things pretty good? In any case, Greenspan at some point tried to pop the dot-com bubble by raising interest rates to 6.5%, and those interest rate increases did actually coincide with the dot-com crash, which was clearly a bubble. Greenspan then cut rates and deregulation in the early 2000s, and there were a number of other things that contributed to the real estate boom and then ultimate financial crisis. But what Greenspan was doing was definitely part of it. Things that happened at the Office of the Comptroller of the Currency, some laws that went into place with regard to financial institutions, allowing the investment banks, Lehman, Bear Stearns, to run leverage way up into the stratosphere. A lot of things went down. Well, Bernanke and Yellen came in, and they became the QE era. So while QE was supposed to destroy the dollar, look at that. QE starts in here, dollar goes up. And now the dollar has been in an even tighter range for 6 years. So you have that, the dollar is going to collapse, hyperinflation, Weimar Republic. I'm trying to tell you the dollar is going to go like that. I'm going to tell you the opposite. I think the dollar is going to stay range bound and really drift higher, at least for a while, at least through spring probably. And I believe that's going to be allowed to happen so that the asset markets correct back to mean. Probably won't go below mean valuations because, heaven forbid, that bad investments get priced like bad investments. But a lot of the froth is going to come out of this market. And we'll see how much of that froth comes out. Here I have the QQQ, and I slapped on the various moving averages. And this price right here, which happens to coincide with the fib line, just happens to be right above that peak in 2020. And it's just above major support starting to develop, because support always moves up. and a 200-day moving average right there. So if the stock market comes down, QQQ comes down, 200-day moving average would level off. And right about where this truck is will probably be the worst of it. Now, I don't know that we're going to get there. I think there's a pretty good chance that the 100-day is where we hold. Maybe right about here, 300-ish. Low 300s on the QQQ. That would be my guess. I have a hard time thinking that we'll get back down to the 200-day moving average. I just think that that is highly unlikely given the nature of the world that we live in. So we go back to inflation. We want to try to understand why things are happening the way they're happening. Now, if you're on margin of safety investing, this is over there. Here it is here. Just a free library card is all you need to see this on fundamental trends. So this is actually a free article. We have to think about what are the correlations of QE. Well, one of the correlations that we know, all right, so we can see on this chart, which I had in another article, that the correlation of QE, which is the blue line, in the stock market is pretty strong. When they started to taper, stock market went through a flat period here, and then started to jitterbug up here, where we had the volatility events at the beginning and end of 2018. Then in September 2019, we started printing money again. And lo and behold, this period here, which is marked by volatility and almost no rise, jumps back up. Coronavirus crushes it. So we do QE to infinity, and the stock market comes roaring back. What else is QE correlated to? Well, it happens to be correlated pretty strongly to gross domestic product. You have a big drop, print money, gross domestic product flies up. But it happened here too. Here's a financial crisis. Gross domestic product falls off, print a bunch of money, gross domestic product comes back. Starts to lag going into 2011 and 12, so they print more money. Comes back up. Starts to lag again, print more money, goes back up. Then the market starts to come back down. We get cheap oil and tax cuts here. It's cheap oil and tax cuts. Then it starts to come back down. So we print money again. This is part of the bailing out the repo market. And that money filtered back in. Then this is, again, coronavirus. What else is it correlated to? Quite a bit to inflation. But weirdly, the correlation of printing money and inflation hasn't been as correlated as you think. Now, prices move around, seasonality, a lot of times first quarter is your weak quarter, but you can see all this money printing has driven the spike in inflation, complicated by oil rising in price, complicated by supply chains being disrupted on the shift away from China, and the fact that machine learning and lower global wage disparities are making it easier to move supply chains closer to the customers and resources. So as you read this, what you realize is that, well, the United States has a lot of customers, and North America in general has basically every resource you could need. If you think about what's been going on in the market, you just saw Canadian Pacific buy Kansas City Southern. Probably didn't hit a lot of your radars. But what is that transaction really? I mean, the reason one of us, and many of us, invested in Kansas City Southern years ago is because we expected a Canadian company to buy it. Why? Because the train route from Canada all the way to Mexico. Kansas City Southern's main asset are routes that run into Mexico. So when you take a look at North America, you have 3 countries, and in a region this big, you could very well have 100, right? Take a look at Europe. It's not as big as North America. How many countries? We have 3 countries here, that's all. Huge area. Canada, pretty affluent. United States, consumer-based, big economy, biggest economy in the world so far. China will catch us eventually. It's really close right now. And then Mexico, which is essentially a developing market, which offers a lot of growth. And we have all sorts of Central Americans trying to move north. So in a world where we don't trust China, and I think that's probably earned on their part, or at least on the Communist Party's part. Again, I have no problem with Chinese people. I have a problem with the Communist Party. We're having a moment in time where the supply chains are disrupted. And we should ask, and I mentioned it in here because I wanted to use the phrase crazy Ivan, could China do something in the next several quarters as part of a way to negotiate a deal on Taiwan that they like? Could they do something with supply chains that would be so disruptive it would cause economic pain to the point where they think they're going to get what they want from Taiwan, which is to absorb it? I will tell you, I think Taiwan is the biggest potential flashpoint on the planet. I don't think we're going to let it fall into Chinese hands. I think we're going to try to cut a deal where the status quo remains. But ultimately, as we have seen with our ships, our Navy ships, cruising right by the island on a regular basis, we're not going to let that island be invaded and taken over by China. It's not going to happen. One of the things that we worry about are semiconductors. That's slowing down the economy right now, particularly in the car market, which is actually fine because it slows down the number of internal combustion engine cars getting sold, which is probably a good thing. And if the oil price is being a little higher, people are starting to rethink the hybrid and EV ideas. EVs are growing at compound annual growth rates that are something like 10 times internal combustion engine cars. And hybrids actually have quite an attraction at the moment. If you don't feel like you can afford an EV, you can go out and get a Toyota hybrid for only $1,000 more than the gasoline powered vehicle and double your mileage. I'd be interested to see what their sales numbers are. I haven't looked. So what is the deal on inflation? I think it's important to consider this chart over and over again. Think about the impact of oil on inflation. The impact of oil on inflation used to be pretty clear in everybody's mind, but it hasn't quite worked exactly the same way, except in this moment. And people have recency bias. I would postulate that the Federal Reserve starts to tighten, basically just withdrawing some of the loose, right? Because they're never really going to get tight, not in a long time. Not until more baby boomers have passed to that market in the sky. The demographics issue is what is driving the slow growth forever in the economy. And until we have a population that's not aging as fast and the population curve smooths out, which is going to take 2 generations, maybe 3, deflation, and I agree with Kathy Woods here. Actually, she agrees with me because I've been talking about this since 2012. Wrote that whole thesis, Slow Growth Forever, in 2016. Deflation is actually the boogeyman. So anytime we get a hot moment on inflation, people want to start their chant. Dollar collapse, hyperinflation, which is stupid because hyperinflation implies triple-digit interest inflation rates. The Federal Reserve is going to allow the dollar to get stronger. What did I say when President Biden looked like he might get elected? I said if President Biden gets elected, that'll mark a bottom in the dollar, at least intermediate term. And look what's happening in the last few months. The dollar double bottomed, just as I said it would. And now it's been rising. So rising dollar, because the QE is going to get reduced, is going to force a lot of asset prices to head back toward their mean valuation. And right on cue overnight, since I've published this, OPEC says they're going to probably release more oil and gas. So you have slightly stronger dollar, more oil and gas. Price of oil and gas is going to come down. By the first quarter. Might be the end of the first quarter. But that'll give the Fed cover to not be as loose. Because really there's enough capital out there right now to rebuild the world. And fiscal policy needs to drive that rebuilding. This whole idea that we're just going to let people hoard their money with the idea that they'll somehow get a return without us building anything or doing anything is naive. Returns on capital come from development, some sort of business development, building. The idea that you can just game the markets to make money without real growth in the economy is ignorant. At some point, the economy has to grow. And because we have the aging demographics issue, you have to rebuild things. Tear something down and put something else up. And with climate change having been allowed to become an existential threat the last 40 years, yeah, it started, it was happening before that, but we've known since the late 60s and the 70s the climate change was happening and that we were probably at fault. It's taken 2 generations for a majority of the population to believe that and for actions to start taking place. Activists taking over the Exxon board, for example. Norway, their pension fund, which used to be called the oil fund, selling oil stocks. The divest movement, causing hundreds of institutions to stop investing in fossil fuels. All these things are tied together. Call them excuses, call them reasons, I don't care. The impact is the same. There's going to be a great bifurcation in the markets. The zombie companies that are propped up on debt but have no growth will shrink, get bought out for unders, right? Buy unders, mergers of unequals for less, and bankruptcies. The oil industry in America has suffered over 1,000 bankruptcies since 2015. There's over 100 bankruptcies last year. So we do have a slightly tighter oil market, but not too tight, because there's more than enough oil and gas for what we need over the next decade or two from the Middle East. So your big winners in oil and gas are going to be Saudi Aramco, I think Total, because they've pivoted pretty hard. They're ahead of everybody else on going towards clean. Pioneer in the United States, because it's the only Permian-focused big company, and they have the best balance sheet. I think Hess and Conoco will chop around. I think Exxon's going to lose 50% of its value again, go back to last year's lows. Chevron probably chops around. You have to remember, companies like Chevron and Exxon, which haven't embraced a clean energy future yet, they have a lot of assets that's very expensive to develop versus what the price of oil is going to be, which is range bound. Discussed that on Forex Analytics a couple weeks ago. So the inflationary pressure from QE is going to dissipate. The inflationary pressure from oil and gas is going to dissipate. Again, what I was saying a moment ago, OPEC just told us less than 24 hours after I wrote this, they're going to release more oil and gas. They've been controlling things on oil and gas. They started 7 years ago. They got all those companies to go bankrupt with the flooding the market of oil. And then COVID kind of finished off the job, it looks like. So now you have a very tight oil market in the United States. We're not, as I said 2 years ago, we're not the marginal oil. We're not the swing producers. It's Saudi Arabia. Saudi Arabia is the swing producer for oil in the world. And if you look at oil and gas from their standpoint, it's really the only thing they can make money on at the moment. So they want a range-bound price of oil so they can provide all of the extra that's needed in China and India and other places, because they have about a decade before oil demand starts to fall, the natural gas demand stops going up. Meanwhile, in the United States, there'll be a handful of companies that do all right, but probably after the next big correction. Because when the price of oil falls from 80 back down to 60, and it will, probably in under a year, a lot of these oil companies that are saying how well they're doing are suddenly going to be faced with the same problem they had 2 years ago. Not enough cash flow to pay down debt, pay dividends, and fund development. Something will have to go. And there's nobody out there who wants to buy their assets. Nobody. There is no market for oil and gas assets right now, unless you just want to give it away. And then maybe somebody will say, well, we'll take the debt, but we're not giving you any money. There's a handful of those where a bolt-on acquisition makes some sense. So what do we have here then? We have QE is going to start going down. It'll push the dollar up in November or December, probably November. Oil and gas prices will eventually fall, so that leaves it to supply chains. When will supply chains correct? When will Intel and Taiwan Semiconductor have fabrication plants in the United States? When will all kinds of products made in China start getting made in Vietnam and Mexico? I can tell you it's happening right now. If you're watching the headlines, you're seeing companies like Target and Macy's renting their own container ships or buying their own container ships, I believe, and moving their operations, sourcing from different parts of the world, a lot of them closer to home. Because again, as we saw with the ventilators, it's pretty easy for American companies with good technology to switch from making one thing to making another thing. Ford, GM to a lesser extent, really good at that. 3M, Rockwell's helping everybody do it. PTC is helping everybody do it. You're going to see these supply chains move very rapidly over the next year to 2 years. So as the supply chains move, deflation will become the boogeyman again. Because unless we build enough sustainable economy, growth is going to be an issue. And we have people out there like Joe Manchin who just don't get it, and their pockets are padded by the fossil fuel industry. You're probably not going to get the reconciliation bill that you need. I want you to consider inflation and policy. They're arguing over $3.5 to $4 trillion worth of new money, which is really for the global economy. We think about it as for our economy, but it's global, right? Because of the velocity money gets spent here, gets spent there, gets spent somewhere else. You've got over $100 trillion global economy. You got politicians stumping over a few $100 billion here and there. Seriously? If we did the $3.5 trillion reconciliation and added another $0.5 trillion to infrastructure, because there was already $0.5 trillion, so $4 trillion of new spending into a $100 trillion economy that's having growth problems. Think that's overkill? Deferred infrastructure maintenance in the United States is somewhere around $20 trillion, and I've seen estimates as high as $30 trillion. And I'm sure that's a lot of people who make money on that. So let's say that the $1 trillion infrastructure budget is 1/10 of what we need. Deflation is the bigger boogeyman right now. And in the very short run, at least for a few quarters, we could get a whiff of stagflation. And if we do, what do you think is going to happen? This is what I believe. I believe that they won't finish the taper because by spring, the economy will have slowed down enough. They're going to get scared. And midterms are coming up. I believe that they flatten the taper, but they continue to buy some bonds all the way through the election. And they might even increase it again by the end of next year. I don't think you're going to see interest rates go up until 2025 or later. You know, maybe a 1/4 point or a 1/2 point. But I mean real increases. You're not going to see a Fed funds rate over 1%, maybe this decade. Why? because deflation is the problem, not inflation. Kathy Wood is right. Larry Summers is right. Neil Kashkari is right. And that particular little group of people, A, is very accomplished, but you have a liberal, a moderate, and a conservative. The moderate being Kathy Wood, who's actually extremely libertarian. So a libertarian, a liberal, and a conservative walk into a Federal Reserve Bank. So some investment quick thoughts. The reason I don't short very much is because the market can stay irrational a long time. If I make a short bet, it's something that I'm going to do quickly and for the short term because I see something happening at that moment. No point speculating on the next downturn until you can see the red in their eyes. And I think that moment's coming. I think the jitterbugging this past month, the 5% correction we saw in September, is a hint. And I think the narratives will get painted in a way that creates downward momentum. I'll be showing some charts in the quarterly outlook tomorrow that demonstrate that the millennials bet both ways. I've hinted at this for over a year now, that they're not long-only investors. They're just in it for the money, and whichever way things move, they're going to run with it. And we just got to study out the old men are the ones most likely to panic sell. So the millennials are going to prey on the old men selling to them. As I've said over and over again, it's been my observation for 25 years that the baby boomers are incredibly emotional investors. And the millennials are going to take advantage of this because they are tactical. They consider themselves data-driven, even though I don't know that they always understand the data. But if nothing else, they're trend traders. If it's going up, I'll ride it up. If it's going down, I'm going to ride it down. Put buying has been going up. That's why you have very high premiums on certain things. And we've had rolling corrections all year already. 90% of the S&P 500 has had a 10% correction already this year. But the small cap stocks and the mid cap stocks, you've seen a lot of 30, 40, 50% corrections. And I'm excluding the meme stocks because some of those are down 90%. And when something's down 90%, what is the only question you should ask? The only question. Somebody give me the answer. What's the only question to ask if you see a stock down 90%? Will they what? Will they what? Will they stay in business? If you have a stock down 90%, the only goddamn question you should ask is, will they stay in business? Because if they will stay in business, then you should buy the stock. Because it's probably gone way below mean. It's probably an overreaction. So if you can identify a company on track that's down 90% and say, it's got a good balance sheet, they have clients, they have government contracts, you're an imbecile not to buy the stock. Even if it goes from 10 to 5 at this point, it goes down 95%. When you see things beaten to the point of being down so much that the narrative is they can only go bankrupt, but you can identify that they're not going to go bankrupt, buy the stock. There was a thread on Twitter that I put up by some guy who went through a lot of the Michael Burry quotes. He went through some of the Michael Burry quotes because back in the day, Michael Burry was all over the internet. Well, this one, right? Everybody talks about buy and hold, like that guy on Seeking Alpha, buy and hold 2012, at the end of a bull market. But they all hate it during a bear market. Emotions, recency bias. Here you go. My strategy isn't very complex. I try to buy shares of unpopular companies when they look like roadkill and sell them when they've been polished up a bit. Pretty simple. In the small and mid-cap space, there are a lot of companies that are beat to heck. And the chief spot that you can find those companies are in the SPACs. Companies that came public via SPAC, some of them spiked, some of them didn't, but the entire sector is destroyed. And the ones that aren't destroyed, some of them are coming back. Some of them have found their plateau. that sideways motion. MP Materials, chopping along in the 30s for a while now. We know they have huge business coming as we transition to EVs, and we know they don't have a lot of competition. When you find companies that have a future and they're priced like they don't, buy those stocks. There's a lot of them in the SPACs. So people on our chat boards, which is why you should be in the chat rooms, have pointed out 3 stocks in the past couple of weeks. One is actually a Warren Buffett holding, and it's not a SPAC. Brazilian fintech, interbottoming process, down 50, 60%. Warren Buffett still holds it. He didn't sell it. And now it's back to the price about where he bought it. Do you think you might buy more? Then there's 3 other stocks that members pointed out, and they're all SPACs. One is a cyber security firm that I was reading up on this morning. Very interesting to me. Seems like a financial event, and the price will probably start going back up soon. Another company in the Middle East that's going to compete with Uber, but also essentially privatize the bus industry in the Middle East. And another company is a battery company that is going to provide utility scale batteries that don't require lithium, which I've been telling you about for just about 2 years that was coming. I wasn't sure which technology was going to win. I think there will be a few winners. But you are about to see, over the next 36 months, a massive ramp up in utility scale power storage, which will drive what down? Will drive inflation down. Why? Because the price of gas is going to go down. We have way more coal than we're ever going to use. Price of coal is going to keep going down, right? These blips on the upside are just little blips. The secular trend has been down for at least 7 years on all 3 of those things. Coal a little longer. The secular trends are what you better pay attention to. Aging demographics and the change in the energy system and technology and how it makes asset-light models better investments, but also improves industry and the economy. So everybody pounding the table about resource stocks, and about real estate, and other capital-intensive businesses. The risk is what if technology overcomes everything else and interest rates normalize faster than we think? Could happen. I'm not saying it will, I'm just saying it could. And what if financing capital projects becomes a little harder to do 2, 3, 4 years out? Once the market sniffs that out, it'll adjust. Maybe a year ahead of time, maybe 2 years ahead of time. So you gotta be very careful with your capital intensive and labor intensive businesses because they end up being very cyclical. And if they're against the secular trends, ultimately, you're trying to paddle upstream. Even if every now and then you're like, woo, I got to go over some, waterfall and it felt good. Somebody asked about Spire Global, which is one of our investments. They said that it got hit today. And here's what I would say about any stock that gets hit. You have to ask, is there some financial event going on? And the answer is probably yes. So in the case of Spire, somebody big sold shares. That's what's happening with one of the companies that was brought up the other day. Oh, yeah, stock offering. Yeah. Sign me up for more shares. I have some puts sold on that one, so I'll end up getting more shares at a net price of about 8. Which is what I keep telling everybody, is that the bottom price of most of these SPACs is around 8 because of the fact that most of them are trading at around book value, which I've been telling you about these satellite companies. Cody Willard recently posted in his newsletter that he's been answering his telephone. If it's not space, it ain't crap. Or if it's not space, it doesn't matter. These space stocks that I've been covering for you, all 5 of them, and I'm sure there's more, but the 5 in our basket all have the potential to be 10 baggers, every single one of them. I'd be surprised if at least 3 of them don't triple, which means the other 2 wouldn't have to do anything, which is possible. Like I said, I think the one company probably gets bought, but we'll see, because they don't have satellites in the air yet, but they have awesome technology. And the other one's in $1 trillion total addressable market for telecom. Yeah. In any case, deflation is the boogeyman, not inflation. Anything with inflation is temporary. So when you project out what you think is going to happen, understand that deflation is what's coming back. And inflation, you know, it's like that cousin that shows up at a funeral here and there. You don't see him very often. Deflation is everybody in the neighborhood that you live in. All right. Have a great weekend. I will have the quarterly outlook and game plan up tomorrow late probably, or very early Sunday before I go out of town. Read the macro dashes. And if you've been paying attention to the VSL, I have been updating it with charts again. They're linked to the bottom fishing prices. And I've simplified the charts. Just one box. This is where I want to buy something in the orange box. I'll buy it first, probably around the top orange line, maybe in the middle, and then near the bottom. If it's above here, you better be a very nimble trader. And if it's below here, sell everything that you own, move into a van and go live by the river, invest everything into it. And then in 2 years, you'll have twice or 3 times as much money. You can buy all your stuff back. All right. So I think QQQ, the worst of it is 250, 260, probably 300-ish. And it could be as high as, you know, middle 300s. All right. Everybody have a great weekend. And remember, inflation is temporary. Inflation is transitory.